Okay, so you want to get started with this whole investment thing. Maybe you have a little bit of money saved up and you think it's probably best if you get it to work for yourself one way or another. Maybe you've heard on the news about companies like Tesla, Netflix, and Amazon, and the fact that if you started investing 10 years ago, by now you could have been a multi-millionaire. Now, for some strange reason, investing seems to be categorized as this super complicated task that's only for the wealthy, especially with people who've never done it before, which makes sense, but trust me, that's not the case at all. And if you watch this video all the way to the end, I promise everything will make sense. Now, all that being said, I get it. It can be daunting if you're just getting started. I mean, how do you even buy a stock? Like, do you just go on Tesla.com and buy a Tesla stock? How does it all work? The annoying thing is that if you try to learn about investing on your own, you just get a bunch of acronyms thrown at you, like Roth IRA and 401k and who knows what else. And to top it all off, we all have this built-in anxiety associated with investing. Like, we don't want to lose all of our money, right? That's the last thing we want to do. So in light of all this, I've created this ultimate guide to help all of you get started with investing. This is the very video that I wish I had 5 years ago when I started getting into investing. So pay attention. We're going to be breaking down how to invest in 10 bite-sized pieces, starting with number 1, to forget about investing completely and to think about what happens to our money over time by default. Now, this might sound crazy, but I want you to imagine yourself in the year 1914. You just hopped out of your bank and you pulled out this fresh, extremely real $100 bill. If you were to then hop into a time machine and then end up in the year 2023, or today, this bill would be equivalent to $2,661 of today's money. In other words, you would need $2,661 of today's money to buy you what $100 would have gotten you in the year 1914. Now, if that sounds crazy to you, trust me, it makes a lot of sense. This dramatic devaluation of our money is as a product of something called inflation. Inflation seems to range between 2 to 2.5% on average every single year. So next year, you can expect the cost of goods to increase by 2 to 2.5%. So what we learned from this is that instead of leaving your money underneath your mattress where it's going to lose all of its value anyways, the goal should be to let your money work for you, and you can do this by leveraging the power of investing. So that begs the question, and key point number 2, what is an investment? An investment is something that puts money into your pocket. Let's say that you invested $100,000 into a rental property. There are now 2 different ways that you can extrapolate income from this investment. A, you can charge your tenants $8,300 a month, which comes up to $10,000 a year. So $10,000 of your original $100,000 investment, that makes it a 10% return on an annual basis. And B, generally speaking, in the housing market, the trend is that the prices of homes increases over time. Now, the only problem with this particular investment is that it requires a lot of initial capital to get started, not to mention that you need an excellent credit score. So if only there was a way that you didn't have to put so much money up front, but you could still expect a 10% return on an annual basis. Which brings us to point 3, what are stocks and how do they work? Now, you can think about it like this. When you buy a stock in a company, you essentially become a part owner of that company. So let's say I were to buy 1 share of Tesla, I now own 0.000 however many zeros of Tesla. Now, let's say that Tesla's performing really well. They released their Cybertruck and it's a hit. They're making tons of money and the value of the stock goes up. Well, then by extension, so would my 0.00001% ownership or my 1 stock in the company. Now, similar to our rental property example where we charge rent from our tenants, we can also collect reoccurring payments from our stocks in the form of dividends. Dividends are a way for a company to share their profits with their stakeholders like you and me. And generally speaking, they're paid on a monthly, a quarterly, or an annual basis. Most of the time, these dividends are paid out by larger cap companies. So at this point, we've talked about what a stock is and how you can make money from it. Now, I'm sure you have a bunch of questions like how risky is it and how much do I need to get started? But before we do, how the heck do you buy stocks in the first place? Now, this is where it might get a little bit tricky because it's not as simple as going to Amazon.com and buying an Amazon stock. Back in the day, if you wanted to get started in investing, you would have to call up your favorite broker, let him know what stock you want, how many shares, and at what price. He would push a couple buttons and boom, you're invested. Now in our case, we can just go online and sign up for our favorite brokerage. Most banks happen to have a built-in brokerage, but they're usually pretty slow and clunky, so there's tons of online options available for you. Things like Webull and Vanguard and many others. But before we get started and throw our own hard-earned money into the market, there's a few things that we must understand, which brings us to key point number 4. How do we know what stocks to buy in the first place? You might not be expecting this, but you're not going to think about which stocks to buy because you're not going to buy individual stocks at all. And that's because investing into individual stocks can be quite risky. I mean, if you were to invest in a company like Amazon, there's a pretty good chance that they'll be around 10 years from now. But historically, there's been tons of companies that have seemed invincible. They had a lot of money and a lot of resources, but they all went bust and bankrupt. Now, on top of that, just because a company has performed well over the last 5 to 10 years, doesn't necessarily mean they'll do the same in the future, because the past is no real indicator for future performance. All that being said, particularly with new investors, the advice is usually to invest into index funds. And this isn't just my opinion. Some of my favorite creators like Andre Jick and Graham Stephan say the same. Which begs the question, and point number 5, what the heck is an index fund? Now, for my visual learners, an easier way to understand what an index is to imagine like a pack of 5 gum. Now, I'm not sponsored, but on the surface, it seems like one entity. But if you open it up, you see all the different stocks that are inside of it. There are thousands of different indexes which follow hundreds of different criterias like dividend stocks, growth stocks, you name it. Now, indexes are a great investment strategy for a number of reasons, and the first one being that they're very easy to get into. If you don't understand technical, fundamental, or sentimental analysis, if you don't know how to read charts or understand balance sheets, then investing in indexes removes that burden from you. They also happen to be an exceptional way for you to diversify your portfolio. In an index like the S&P 500, for example, which is split between 500 of the US's top stocks, as well as several different sectors. So in the face of even a terrible, catastrophic economic catastrophe, an entire sector were to be destroyed, the majority of your portfolio would go relatively unharmed. Now, on the other hand, if you were to throw all of your money into one individual stock and they were to go bankrupt, your hospital bill would go from 0 to 100 real quick. Also, assuming you're well diversified, the idea that you're going to lose all of your money investing into the stock market is extremely unlikely and shouldn't be anything that stops you from getting started. In the short term, markets do experience some volatility. Prices will go up and prices will go down. But over the long term, historically speaking, prices have always gone up. So in that case, using your index as a sort of savings account and keeping your money in there for several years is your best bet to make money based on the facts. Which brings us to point number 6, when should you start? Now, the bottom line is that you should start as soon as possible. It doesn't matter how old you are or how young you are, the sooner the better. And in that way, you can leverage compound interest to build up your portfolio. As the great Einstein once said, compound interest is the 8th wonder of the world. He who understands it earns it, and he who doesn't pays it. This is all assuming that you don't have any high interest credit card debt built up already. And if that's the case, then you should prioritize paying that off before you start getting into investing. This will eat away at your bottom line every month, and it's not a good idea. Secondly, you should already have an emergency fund saved up. And third, you shouldn't require the funds in the next 3 to 5 years at minimum. Almost there, and the last point is, how do I start? Assuming you watched this entire video, you're sold, and you're ready to invest your first $100 into the market, your first step will be to choose a broker and to set up your account. Once your account is created, which in some cases may take a couple of days, your best bet is to start to build healthy financial practices by putting aside a certain amount of money every month. Try your best not to obsess over the price of the stock every hour. I promise you it's not going to go anywhere. It's just going to drive you insane, and this is a mistake that I made when I first started investing. The goal with investing, not just with stocks in particular, but with investing in general, is to be patient, because investing is essentially just the exchange of wealth between the patient and the impatient. I hope this was a reasonable introduction to how you can get started investing into index funds. And I understand that you might have more questions along your journey, so go ahead and leave them down in the comment section below. If you want to learn more about stocks and dividends, I recommend you click right here. As always, thank you so much for watching, and I'll see you guys